Greetings, and thank you for joining us today. I'm Steve Kamen, a senior fellow here at the American Enterprise Institute. And it's my pleasure to welcome you to this afternoon's event on inflation, monetary policy, and prospects for the global economy. I especially wish to welcome our panel of highly distinguished experts and policymakers to this afternoon's session. I can't think of a better panel to shed light on these important issues. Now, by way of introduction, there are certainly times when the issues that attract the attention of economists and financial experts, like intervention in foreign exchange or liquidity in the repo market, seem utterly esoteric and irrelevant to the lives of ordinary folk. But these are not those times. Every time you fill up your gas tank, do your weekly grocery shopping, or go online and check the value of your 401k, something I would not recommend, by the way, you can see the global economic crisis in action. And indeed, inflation around the world is hitting its highest levels at 40 years. This by itself would be enough to put a damper on everybody's holiday mood. But on top of it, central banks are responding to rising inflation by pushing up interest rates to levels not seen in decades, threatening to disrupt financial markets and even push the world economy into recession. And all of this comes against the background of Russia's invasion of Ukraine, soaring food and energy prices, natural gas shortages, a slowdown in China, and rising indebtedness in the emerging market economies. So for central banks attempting to steer the economy between the rock of inflation and the hard place of recession, the current situation is extraordinarily challenging. Not only are the risks inordinately high, but the critical questions are even more impossible to answer than usual. The first of these is, how quickly should central banks raise interest rates to get inflation down? And how long should those interest rates be kept high? This has always been a difficult problem for central banks, and it's even tougher now when we don't know exactly what is pushing inflation up and why it's been so persistent. Moreover, the driving forces are quite different in countries such as the United States, where strong demand seems to be a factor, and the euro area, where rising energy prices have been much more important. Now, a second question that central banks must grapple with is, do swiftly rising interest rates and quantitative tightening threaten to push the global economy into a recession or a financial crisis? Again, this is a standard concern for monetary policymakers during a tightening cycle, but it's even more salient today given all the other downdrafts on the global economy, as well as the fact that financial markets had become accustomed to very low for long interest rates and are now being shocked into a very different regime. Finally, by driving up the dollar, the strenuous monetary tightening by the Fed put the rest of the world's economy at risk. Critics point out that the strong dollar is exporting inflation and driving up debt burdens for emerging markets. So just how worrisome is this development? Given the utter intractability of these issues, we needed an exceptionally wise and experienced group of experts to address them. In the order in which they will speak, they are: first, Jason Furman, who's the Aetna Professor of the Practice of Economic Policy at Harvard University, as well as a non-resident senior fellow at the Peterson Institute for International Economics. Among many other things, Jason has been a top economic advisor to President Obama, including chairman of the Council of Economic Advisors, as well as an advisor on economic policy during the Clinton administration, and he's also headed the Hamilton Project at Brookings. Secondly, Catherine Mann is an external member of the Monetary Policy Committee of the Bank of England. Prior to this, Catherine was, among other positions, the global chief economist for Citibank, chief economist at the OECD, professor at Brandeis, senior fellow at the Peterson Institute, assistant director at the Fed, and last and most certainly least, a classmate of mine in graduate school. Third, Claudio Borio is presently head of the Monetary and Economics Department at the Bank for International Settlements, which is a forum and bank for the world's central banks. Prior to a long career at the BIS, Claudio has been an economist at the OECD and a lecturer and research fellow at Oxford University. Finally, Desmond Lockman is a senior fellow and colleague of mine at the AEI, where he writes extensively on emerging market issues, monetary policy, and the financial system. Before that, he was managing director and chief emerging market economic strategist at Solomon Smith Barney. Desmond has also served as deputy director in the International Monetary Fund's Policy Development and Review Department. Now, if you in the audience have questions that you'd like to ask of the panelists, you can send them to Beatrice Lee via email or Twitter, as indicated at the bottom of your screen. Okay, so without further ado, let me give the floor over to Jason to begin our discussion.
Great, Stephen. That was a wonderful but scary introduction. I'm going to talk ostensibly about the world economy's inflation challenge, but I'm going to focus especially on the United States. And just for fun, there's a lot of different things that could happen in the United States. People use different words. I never quite know what the words mean. I never quite know what probabilities they're attaching. But I think of the world of, are we going to have high inflation or low inflation? I'm going to define that as a cutoff of 3% in the second half of next year. And a world where, do we have a recession or not? I'm going to define that as a 4.5% maximum unemployment rate in 2023. And the different scenarios are we going to have a soft landing? Are we going to have continued overheating where the unemployment rate doesn't rise that much and inflation stays high? Hard landing, we solve the inflation problem, but we solve it with a recession. Or stagflation, we end the next year with high unemployment and high inflation. Let me give a little bit of my thinking that goes into these probabilities. And then if you pay attention at the very end, I'm going to tell you 4 numbers that add up to 100 for these parts of the matrix. So the first thing to understand is that the nature of the inflation in the United States and Europe is very different. The United States is about 6% above its pre-pandemic trend for nominal GDP. Europe is roughly at its pre-pandemic trend. Inflation is a big problem in both countries, but in Europe, it's a bit more of energy is expensive, so output is lower and inflation is higher. In the United States, everything is higher, real and nominal and prices. There's been an endless debate about decomposing supply and demand. I could give you an hour on it. If I had to pick one chart, I'd show you this one. It's from the San Francisco Fed, Adam Shapiro. And basically what he does in his analysis is if the price goes up and the quantity goes up, then the demand increased. The price goes up and the quantity goes down, then there was some form of supply disruption that drove the price up. And the thing to note is this is excess inflation. So it's increase in inflation relative to what we had before. And that almost all of the recent inflation is on the demand side. There's very little this year that's coming from the supply side. Now, where is the inflation? At this point, it is very much rooted in the labor market. Nominal wages are growing at about 1 to 3 percentage points faster than they were prior to the pandemic. If you look at the highest quality measures, the ECI, they are consistent with a core PCE inflation rate of around 4.5%. It's just very hard on a sustained basis to have your compensation growing or wages growing at 5.5% and not pass through about 4.5% of that in the form of prices. Moreover, I think the historical relationship between compensation and prices, which is what I'm using as the basis for this table, is I think roughly the right one to use. We're roughly at trend productivity, and lately unit labor costs have roughly been tracking price growth. And so there's no reason to believe there's any obvious reason why the historical relationship would be higher or lower than what it was. So we have an underlying labor market telling us that price inflation is going to be at 4.5%. I find this much more useful than talking about shelter and healthcare and finance and restaurants and airplanes and all that stuff. All of that micro story washes out. I think this macro one is the big one. So why do we have this macro story? We have this macro story because job openings are much higher than they ever were prior to the pandemic. Quits are higher than they ever were prior to the pandemic. There's currently 1.9 job openings for every unemployed worker. The quits rate very high as well. Now, a very big open question is all of this improvement has happened without any deterioration in the labor market. The unemployment rate has stayed low. Can this continue to happen without the unemployment rate going down? That's never happened before, but a lot of things that have never happened before have happened lately. So I think it's possible. I just don't think it's probable. The 50th percentile of my expectation is not that job openings is going to come back to pre-pandemic. That's more like the 85th percentile of good outcomes. But labor markets are a bit less tight than they were. The other big open question is inflation expectations. These are long-run expectations. They're well anchored. They've only increased a tiny bit, and they're at a perfectly fine level. The people who are unconcerned about expectations point to that. But what about short-run expectations? They've increased quite a lot. They're at a dangerously high level, and they're what probably actually matters for wage and price setting over the next year. I think we can't assume for certain that only long-run inflation expectations matter. Again, maybe in the 85th percentile of good outcomes, that's what matters. But integrating across all the possibilities, I place weight on the short-run expectations too. So what should policy do? Policy has been extremely aggressive in raising rates. The speed at which monetary policy has tightened is extraordinary. The absolute level of tightness is still not that extraordinary. We're talking about a Fed funds rate of 3.75, headed maybe to 5 something. We're talking about mortgage rates that we've seen before in normal times. We're talking about real interest rates, long-term real interest rates of 1.75. I mean, none of this is that extraordinarily tight, but the change has been very large and very fast. Well, there's a worry about lags. And people who are worried point out that spot shelter has decreased, and that hasn't showed up in core inflation yet, and that monetary policy hasn't fully shown up. Now, I do want to remind us there are other lags too. Fiscal policy has long and variable lags. We did a 25% of GDP fiscal stimulus. Some of that is going to play out 2-3 years after you did it. The tight labor market, usually we think of the labor market affecting inflation with a lag, and it's been very tight, and it tightened over the course of this year. Some of that probably hasn't fully played out in terms of the wage price dynamic yet. And inflation expectations, if we spend 2-3 years well away from 2%, do those long run inflation expectations start adjusting? Do they adjust with a lag? No one has a great quantification of any of the lags in monetary policy. I'm just showing you here one from Goldman Sachs. It's based on their model of changes in financial conditions on the economy. And what you can see is that they think that the monetary policy to date, this doesn't count yesterday's meeting, but that barely changed financial conditions. Monetary policy to date, they think has had a pretty large impact, -2% on real GDP. And remember, we just had a quarter where we had 2.6% GDP growth annual rate, and that might be revised up. They think monetary policy is going to increase, but then start dying out. We're nowhere near our inflation goal. We're 3 percentage points away in terms of core inflation from our goals. Monetary policy is already having a big impact. There's other lags that are going to continue to go the other way. And so I think it's really important that the Fed still stick with it, the very least not try to ease financial conditions, and can step down to a 50 basis point increase next time is fine. 50 or 25 the time after is fine with me too. But the goal should not be any premature easing of financial conditions, because I think it's more likely that financial conditions will have to tighten than that they'll have to ease. And it's always best to avoid zigzagging. So let me end where I began and tell you my answer to these questions. For the soft landing, there is exactly a 10% chance of it happening. There is a narrow path there, but I think it's really narrow given how embedded the inflation is and how the sacrifice ratio is quite painful. For continued overheating, think there's a 30% chance that next year we're having the same conversation. The unemployment rate is on the low side. Inflation is on the high side. The hard landing is one that a lot of people think is going to happen. I look at previous recessions and see them only knocking half a point to a point out of the inflation rate. I look at the sacrifice ratio in the lot. I think it's hard to bring inflation down. So yes, I think there's a decent chance of a recession, but I don't think that recession is necessarily going to solve our inflation problem. The most likely outcome at 40% is what I'm calling stagflation. You might call it an incomplete hard landing. So, but this is, we do have a recession. We do have inflation come down, but it doesn't come all the way down below 3%. And so we're still grappling with inflation at the end of next year. And I think that's the one thing that I think the markets currently don't fully appreciate is just how long we might be grappling with the inflation problem and how it might ultimately require rates to go above 6%. To be clear, that's not my best guess. My best guess is the low fives, but above 6, I think, is completely conceivable. And this could be a multi-year process to deal with this inflation. Thank you.
Thank you, Jason. That was almost unconscionably comprehensive and blew many of the questions I prepared for you out of the water. But rather than go to the bottom of the barrel of the questions I had, I want to actually ask you a question that directly responds to the last thing you said. So, first of all, kudos for actually quantifying not just those 4 different scenarios, because I've seen those before, but actually specifying what those scenarios mean in terms of inflation and unemployment. So that was very helpful. So I want to ask you about the stagnation scenario, which, when I have to say 40% seems awfully high. And I just want to ask you to kind of flesh that out a little bit. Does that occur because there's something structural or entrenched in the US economy that is going to basically force high inflation on us, regardless of what the Fed does? Or is that like a suggestion that the Fed will lack the willpower to go all the way through with its plans to get inflation down, because several years of high unemployment basically deter it from doing so?
Yeah, so great. So first of all, let's just make sure we're not disagreeing about the words and that we are actually talking at the economics. That scenario was maximum unemployment above 4.5%, inflation in the second half of the year above 3%. If you want to say, I shouldn't have used the word stagflation for that, that's fine. I have an open mind on what word you use for that. The reason I said that is I think, core inflation recently has been about 5% annual rate. When I look at wages, it looks like the underlying inflation rate is more like 4.5%. And then I ask, in past recessions, how much did it go down? Or what's the sacrifice ratio in terms of how many point years of unemployment do you need to bring inflation down? There are a lot of lags in the system of wages and prices that affect each other asynchronously. And so I think taking 2 percentage points out of inflation is something that either is going to take a mild recession lasting for a while or a very deep recession. And I actually don't think we're going to have a very deep recession on the time scale of 1 year. I think household balance sheets especially are still healthy enough that you could have a recession without consumer spending plummeting. So I don't see a deep recession. Moreover, even a deep recession might not be enough on that time scale to get inflation below 3.
Okay, well, that's certainly food for thought. So why don't we move to the U.S. economy, which looks good, to an economy that, frankly, at least maybe Catherine will dissuade us, but might look even worse. And I look forward to hearing what you have to say. And thank you also for coming at us at this very busy time with your bank having made its announcement today and released an entire monetary policy report as well.
Great. Well, thanks very much. And we're also going to try to share the screen here. So what I'd like to do to take the prompt from the title of the session here is to talk about inflation in the context of the MPC's forecast for the UK economy and how that informed our policy decision. We did issue a forecast today, which included a detailed analysis of the UK economy. It's called our Monetary Policy Report. And the material that I'll be talking about today is from that report. So as a backdrop to the decision that we made about monetary policy, these two graphs really do tell us the most important pieces of information. This is about consumer prices and about consumer price inflation. So on the right-hand side, we've got consumer price inflation. So you can see how high consumer price inflation may rise in the course of the next year, over 10%. But you can also see how dramatically it is expected to fall to the end of the forecast horizon, and in fact to fall below our target of 2%. So where do we get that dramatic, sometimes we call it the Matterhorn chart? It comes from the assumptions that we have with regard to the level of consumer prices. And that's what's shown on the left-hand side. So you can see how much prices have risen. That's the teal bar. It shows what our CPI, the level of consumer prices are, how much they are supposed to projected to increase, but also that towards the end of the forecast horizon, you can see this leveling off of consumer prices at a much higher level. But because they start to level off, that translates into this dramatic decline in the pace of consumer price inflation, which is what we see on the right-hand side. So it's this combination of both levels and the dynamics that we think of in levels, as well as how that translates into consumer price inflation, that gives us this profile that we have for consumer price inflation. Both of these are important when we think about the decision that needs to be, that we did make and reported on today. So going down to what our forecast actually looks like in more detail over the forecast horizon, this is the way we present our forecasts. It's with a fan chart. It gives you an idea of the types of uncertainties that are associated with the projections that you see in the slide. We are projected to have inflation fall below our target by 2024. But we also prepare, when we do these projections, we also deliver what we think of as potential risk scenarios. And often those risks are balanced. In other words, things could happen on the upside of the central tendency or the downside. But this time around, we put a very large skew, in fact, probably the largest skew ever, into the inflation forecast. And that skew was to the upside. So I want to dig into these projections just a little bit because there's some very important conditioning assumptions in these projections that end up to be very important when we want to communicate our monetary policy decision and additional guidance. So the conditioning assumptions for these forecasts, and I'm showing you the inflation forecast, but of course there is also a forecast for GDP and for employment as well. But I'm showing you the CPI inflation forecast because the remit for the Bank of England is a 2% objective for consumer price inflation, headline inflation, not core, for headline inflation. And then we do have a secondary remit to follow that remit of 2% inflation at all times, so long as to not introduce excessive volatility in economic activity. So the conditioning assumptions that I've written here over here on the right-hand side are with regard to the path of energy prices, as well as the important fiscal policy that we had already been announced, with regard to an energy price guarantee, which limits the extent to which households are exposed to the full range of energy price assumptions that we have in our model. Now, we know exactly what that energy price guarantee looks like for 6 months, and we know that there will be an additional path for fiscal policy after that, but we don't know exactly what that fiscal strategy looks like. So we have a stylized working assumption for what the energy price guarantee might look like beyond the 6-month horizon, but it is a very important conditioning assumption underpinning not just the inflation forecast, but also the forecast for the GDP and employment. The second conditioning assumption, which is a standard conditioning assumption, and that is that we condition our forecast on what the financial markets believe the bank rate is going to be over the forecast horizon. So that's why I put in red that the CPI inflation projection is based on market interest rate expectations. Now, this is important because the conditioning assumption for market interest, for what the market sort of thought that the bank rate would look like over this period, had a peak of about 5.25% over the next year, and then there was some hump at 5.25%, and then there was some reversion. Now that's, we'll see, is not what we think is likely to be the profile for the bank rate going forward. And of course, we also have domestic and international forecasts for labor market characteristics, both domestic and abroad, and the range of other things that one puts into a forecast. Now, when we look at this picture on the right, on the left-hand side, those conditioning assumptions translate into the forecast, but there are 3 really important drivers of the dynamic that you see there. One of them is the base effects associated with the external prices, particularly energy and goods, tradable goods. And that base effect is what I showed you already, is that flattening out of the consumer price level. The second key ingredient to the forecast driver here, the dynamics rapid decline in the inflation rate in projections, is economic slack that comes from the cost of living squeeze, in other words, from the energy prices and for the price of other goods and services, but also from this market interest rate assumption. And about half of the deterioration in economic activity over the forecast horizon comes from the market interest rate assumption. Now, we are in this period of time projecting the UK economy to be in recession for almost 2 years. And it is because of this combination of the cost of living squeeze and the explicit market interest rate conditioning assumption. And then the third ingredient that is important in this dynamic of inflation coming down rapidly and then ultimately ending up below our objective comes from an assumption with regard to the moderation of inflation expectations. Now I'm going to spend a little bit of time talking about inflation expectations because the skew that we have in these inflation projections come primarily from our views about the potential upside risk to inflation persistence. In other words, that this moderation of inflation expectation may not actually be as strong a driver of a deceleration as is currently in the forecast. That's what the skew is all about. So before I get to the talking about inflation expectations, let me just, in case you weren't listening to the press release and the press this morning, the monetary policy decision that we made. The bank rate increased. We increased the bank rate by 75 basis points to 3.0%. It was our 8th increase, consecutive increase since last year. However, we also provided additional guidance that further increases in the bank rate may be required because of these inflation skew, but those further increases in the bank rate that might be required would be to a peak lower than that priced by financial markets. And that has been embodied in our projections according to our conditioning assumption. So this last piece of information is a very important piece of information for our decision. And that, of course, there are considerable uncertainties, as I said, particularly with regard to inflation persistence. So I want to dig down a little bit into the composition of our inflation projections and then end up with talking a little bit about inflation expectations. Again, these are from our monetary policy report. So when we look at inflation, we can see in this decomposition the extent to which it is driven by energy prices and services and core goods are increasingly important. So the energy price guarantee is going to be an important ingredient in that tipping over of the purple part in the middle. But an important ingredient also is whether or not other goods, from tradable goods, coming potentially from the global marketplace, also start to decelerate. And at the same time, counteracting that is a potential increase. And we do see that increase in services, representing 43% of the basket, which is in that bottom green. And the concern there is it's currently running, as you can see, at the decomposition is about 3%, and it usually is running below 2% if you look back to the historical experience. So that is the embedding of energy prices and other external tradable goods prices more generally into the price and wage setting behavior in the broad-based services industries. Now, turning to expectations, an important ingredient in when thinking about potential concerns about persistence, we're looking at a couple of different measures that do show upside risks to both trend inflation, underlying inflation measures, as well as medium-term inflation expectations. On the left-hand side are the actual CPI, which is in the purple. So you can see that running at about the 10%. But you can also see two different measures of underlying trend inflation. The underlying inflation measure, which is a dynamic factor model driven decomposition of underlying inflation in the teal, and also another measure of this average inflation in so-called lowest volatility quintile bucket of product categories, services and goods categories. And as you can see, the extent to which these underlying inflation measures, which tend to move very slowly, you can see that in the historical experience, that these now are outside of previous bounds of their behavior, particularly the average inflation in the lowest volatility quintile, which is a sort of a decomposition that I've been using since I got here about a year ago. On the right-hand side, we're looking at medium-term inflation expectations. This is somewhat similar to the time horizon that Jason mentioned. In our case, we are looking at both households' inflation expectations in the medium term in the blue line, and decision maker panel. This is firms. This is their medium term inflation expectations. So for households, this informs what kind of wage settlements that they might be looking for. And as you can see, well above 4 for their medium term inflation expectations. And then for firms, this is what they think that they're going to be able to get with regard to pricing in the marketplace. And you can see there again, well higher than our 2% objective. So in the medium term, we worry about inflation expectations drifting because once they drift, they can be harder to bring back. So the last point I wanted to bring forward is why we care about medium-term inflation drift and why we care about inflation persistence and why we rose the bank rate by 75 basis points this time around. is that once inflation at the expectations in the medium term start to drift, you end up with a shifting Phillips curve that you can see in this diagram between pi star and y star. That's where we would like to be. That's our target for inflation at 2% and our sustainable long-term growth at y%. Once we have a medium-term drift in inflation expectations, it's much harder for us to achieve that combination of pi star and y star, which is the objective of sustainable long-term growth. So this is why we increased our bank rate, or this is one of the reasons why we increased bank rate by 75 basis points, and why we may have to increase bank rate further if the economy evolves the way we have projected it. But at the same time, those very significant increases in or deceleration in associated with economic activity slowing in the medium term, that 8 quarters of recession, we do not think that the interest rates have to be as high as the financial markets gave us their expectations back when we were driving the underlying assumptions for the forecast.
Catherine, thank you very much for that very comprehensive and insightful presentation. That was very helpful, especially, as I say, coming off of a very busy day for you. I wanted to, as in the case of Jason, you seem to have covered an awful lot of the bases I was going to ask you about. But I wanted to, to first register some surprise that over the last few meetings, the Bank of England has actually been predicting a recession, which is something the Fed tends not to do.
Right.
I know that the Fed, I know Fed staff tended never to forecast recessions. So anyway, I guess I would call that an act of courage. But apropos of that, I noticed, just kind of quickly reading through the support of, the documents that the MPC released, that you anticipate a recession not only kind of like under the market path of interest rates, but even under a path of interest rates that stays constant at the new 3% level.
Yeah. So
in other words, even if you don't raise rates anymore, you're still going to get a pretty long and, I guess, moderately deep recession. And so I guess some question about that is and some of your members, a couple of them, thought you really didn't need to raise rates as high as you did, and maybe you don't need to raise them further either. So what is the argument for continuing to raise rates, even if you're already projecting a recession? Do you think that perhaps it's just that you don't anticipate a deep enough recession if you keep interest rates where they are to do the job of getting inflation down? Or are there some channels by which monetary policy tightening work that kind of like can act directly on inflation without necessarily impacting the economy? So I was wondering if you could kind of like flesh that out for us.
Right. So the first point is that, as you could see in the projections, there still is a lot of momentum in the underlying drivers, domestic drivers of inflation. This is why there is the positive skew that in our inflation projection. So the bank rate rise that we announced today, as well as the potential for future increases, it is because the dynamics of domestic inflation are still quite strong. We still see those medium-term inflation expectations. We still see wage settlements and pricing expectations to be 5%, 6%, 7%. So there still is a tremendous amount of momentum in the wage and price setting process, and that is something we have to lean against. Now, the question as to, and of course, the point being is that if inflation gets worse, then we have to do even more in terms of some future dynamics and in terms of raising rates in the future. The second point, though, about the recession, as you pointed out, there is a predicted a recession even if we stopped raising interest rates right now. If we kept it at the constant rate path at 3%, our current situation at 3%. What this is identifying is the extent to which the cost of living squeeze and the cost of production have increased because of the terms of trade turning against us, both the terms of trade with regard to energy, where we are an importer, and the terms of trade in the goods markets, in global goods prices. So these price increases that come, over the transom, come from abroad. These make us poorer, and monetary policy cannot offset those terms of trade losses. We can only try to offset the domestic embedded nature of the energy and some of the cost of goods and imported materials. So we lean against the domestic embeddedness and the domestic inflation expectations, but we cannot offset the fact that energy prices have increased so dramatically for the UK, nor can we offset the fact that global goods prices have been dramatically higher. And that fundamentally makes us poorer.
All right, thank you for that helpful answer. Why don't we now turn to Claudio Borio, whose job is to follow monetary policy all around the world and make it better, even better than it is.
Well, I'm not so sure about the second point, but we definitely follow policy around the world. And sort of let me say that in contrast to what we heard so far, I will not really make forecasts because that's not our job at the BIS. But what I will try and do is to provide a lens through which you can try and interpret what is going on at the global level in particular. So first of all, about the causes of inflation, how much of it is supply or demand, and then questions about how monetary policy should respond to what we're seeing. As regards the causes, well, there is no question that the war in Ukraine has added a lot to inflationary pressures more recently, and that it has been a major negative supply side shock for much of the world. Of course, this shock has been felt unevenly across countries based on their exposures, in particular to energy and food prices. It's been big in emerging market economies, particularly because when it comes to inflation, food and energy have a big weight in the CPI basket. It's been very big in Europe. The euro area is heavily dependent on Russian oil. There is a huge terms of trade loss, and in this sense, it's quite similar to the terms of trade loss that we have seen in the UK. And it has been less big in the United States because the US is not dependent on Russian oil, Russian gas in particular, as we know, and it's in fact a net exporter of energy. But the global surge that we see clearly precedes the war and has its roots in the pandemic and in the response to the pandemic, in the policy response to the pandemic. Now, the best explanation, of course, it's not a foolproof explanation that we have developed in the annual economic report, which came out in last June, is the following. We emphasize three factors. First of all, the surprisingly strong rebound in aggregate demand. A lot of this was simply a natural rebound following an artificial repression of demand as a result of the policies that were implemented during the pandemic. But in particular, fueled by very forceful, I would say, unprecedented fiscal and monetary policy support globally. And I don't think we should underestimate this second point. The second factor is surprisingly persistent rotation of aggregate demand from services to goods. We expected it to come back, but it didn't quite. And that put a lot of pressure on global supply chains. And finally, of course, surprisingly inelastic supply that was not able to keep up with the change, with the pace of the increase in aggregate demand. And the way that I like to think of this is like the ructions once the global economy, the global engine, was turned on after having been off for quite some time. But after you've kicked it hard, then on top of that, you added some kind of high octane fuel. Now, less metaphorically, perhaps, I think that the kind of inflation that we have seen for some time bear some resemblance to those that would take place after wars in general, not the current war, but previous wars. And by that, I mean the adjustment of an economy transitioning from a wartime to a peacetime configuration, pent-up demand, and policy support. Now, at the BIS, we have been concerned for some time about the risk of inflation becoming entrenched. And this has been partly supported by a kind of analysis we've put forward in the annual economic report. There's a whole chapter, and we will coming out with a monograph on this, that views the inflation process in a way which is somewhat different from the traditional Phillips curve, although it's a complementary way of looking at it. And what we have in mind is a two regime process, high and low inflation, with self-reinforcing transitions from low to high inflation. And what do I mean by all this? Well, actually, inflation behaves very differently in the two regimes. There is plenty of empirical evidence to this effect. In a low inflation regime, what we measure as inflation actually is largely the result of a myriad of relative or sector-specific price changes, which leave only a temporary imprint on inflation itself. Moreover, wages and prices are very loosely linked, so that in this regime, inflation has a number of self-stabilizing properties or mean reverting properties. Now, in a high inflation regime, things are very different. The common component behind price changes is much higher. Wages and prices are much more closely linked, so that there are no self-stabilizing properties as those that we have in a low inflation regime. In fact, inflation is much more responsive to typical supply shocks as the ones that we're seeing now. Why do we say self-reinforcing transitions? Well, a number of reasons. First, and I'd like to emphasize that, is that what happens is that inflation snaps out of the zone of what you might call, or some economists call, rational inattention, in which it doesn't really have much of an impact on people's behavior, into the region of sharp focus. And if you like, the definition that both Volcker and Greenspan gave of price stability was very much an area or a region in which inflation was not having much of an impact on agents' behavior. And I think that we actually come out of a period like that. Second, as inflation rises, it becomes more representative of the price indices that agents care about. Because, as I mentioned earlier, price changes become more similar and more synchronous. So they act more as a kind of coordinating device for agents' decisions, so that the likelihood of wage price spirals increases. And finally, as we know, once inflation is high and persistently so, then an inflation psychology sets in. Way and beyond, I would stress, the de-anchoring of inflation expectations. We have more frequent price adjustments. We have calls for centralization of wage formation. We have strikes. And of course, if people expect inflation to become ingrained, you also have indexation and a shortening of contracts more generally. Now, arguably, there are features in the Phillips curve approach that tend to play down such risks. And let me just mention a few. First of all, given the way that economic slack is typically measured in terms of output gaps, there is no role for sectoral developments as those that we have seen. And a lot of what we actually saw was interpreted for quite some time simply as shock. And by construction, in a Phillips curve, these shocks leave only a temporary imprint on inflation, and they don't really give rise to wage price spirals. So if labor, for example, has lost 20% of its real income, real wages, unless inflation expectations go up, they will not be asking for higher wages, which is really not what happens in the economy. And also, this is also true of commodity price changes, which tend to be treated as a temporary impact on inflation, regardless of their causes. And last but not least, and this is critical, of course, the parameters are treated as exogenous with respect to the level of inflation itself, which tends to rule out these self-reinforcing transitions, quite apart from the fact that they have been estimated over a period of very low and stable inflation. So what does all this imply for monetary policy? Well, clearly, this two-regime view of inflation puts a premium on timely and a forceful response. Because by the time inflation crystallizes in a full-blown wage price process spiral and becomes entrenched, the cost of bringing it down would be too big. But of course, and this is also very important at the current junction globally, the calibration at this stage is complicated by a key factor, which is that policymakers are facing a historically unprecedented configuration, again, at the global level. There are country differences. But this is that they're facing recession risk in the context of a combination of monetary policy tightening to prevent inflation from becoming entrenched and widespread financial vulnerabilities. First and foremost, in the form of debt levels, which are historically high, both private and public. And of course, we know very rich asset prices. And at the macro financial linkage level, real estate prices are particularly important. Why do I mean that this is unprecedented? Because if you actually look at the nature of recessions over time in the post-war period, you will see that before the mid-1980s, the typical recession would be caused by a rise in inflation, which would cause a monetary policy tightening, but with very little actually happening to the financial side of the economy. No, you didn't see much of a credit expansion before it. You didn't see much of a big increase in asset prices and the like. Now, post the mid-1980s, we had a completely different type of recession. We know that inflation was low and stable, so there was little need for monetary policy to tighten. But we saw big financial booms turning into financial busts, and the great financial crisis is the most obvious example. And of course, I'm not talking about the COVID crisis, which is sui generis. So what we had actually seen was a shift from what you might call inflation-induced to financial cycle-induced recessions. Now, what we are seeing is precisely a context in which central banks are forced to raise interest rates to deal with this surge in inflation, but with widespread vulnerabilities in the form, as I said, of high debt levels and real asset prices. Now, if we dig a little bit further into this question of the financial vulnerabilities, what is the state of the financial system? And again, I'm taking a global perspective here. Now, we know the banks are in a much better shape than they were before the great financial crisis, largely as a result of regulation and much higher capital levels. But the same cannot be said of the non-bank financial intermediation sector, which has grown in leaps and bounds since the great financial crisis. And we saw problems, ructions in that sector. Well, first of all, during the March 2020, but also more recently in the UK. But I think this is more like a symptom of broader vulnerabilities that are out there. So what's the implication of all this for monetary policy tightening, for how to tighten monetary policy? Well, as I mentioned earlier, the tightening has to be timely and forceful. It has to be firm. It has to be with a steady hand. But, and this is very important, it has to be ready to adjust to evolving circumstances because of the uncertainties involved. So in this specific context, forward guidance is not particularly well suited. If you're not sure about how far you will go, at what speed and for how long you will stay there at the high rate, at the peak, it's better not to presume that you do so. Now, another thing which I think is very important in this context is that I think is going to loom large in the years ahead is the interaction between monetary and fiscal policy. Now, one aspect of that interaction is standard, which is the fact that tighter monetary policy will make fiscal policy consolidation harder. One aspect is less standard, and probably it has not received the attention that it deserves. And that is that the large-scale asset purchases of public sector debt, of government debt, that many central banks, particularly among the large advanced economies, have embarked on, have increased the sensitivity of the fiscal position to interest rate increases. You can think of this as a very large debt management operation that replaces long-term debt with debt which is indexed at the short-term, actually overnight maturity, which is bank reserves. So that what may look like long-term debt, if you just look at the sort of debt side of the government, actually is in fact short-term debt, and that will show up as lower remittances from the central bank to the government over time, and indeed for many central banks, outright losses. Now, of course, this could have significant implication for the monetary policy headroom. And yes, Steve, let me stop here.
Thank you, Claudio. I'm torn between suggesting that you've offered a great deal of food for thought, or suggesting that you've opened a lot of cans of worms. But
both, perhaps.
Yeah, well, we shouldn't mix those metaphors. So, all right. So I'd like to go back to, I thought what was very interesting, which was your two regime story, and that I think provides a great rationale for the kind of like risk management approach toward monetary policy tightening that we're seeing in the U.S., in the U.K., and elsewhere. And I guess I just had a couple of related questions. One of them is that approach, and frankly, none of the discussions that we've heard so far have actually helped us decide what is the right policy interest rate to shoot for. And I guess in the absence of a reliable model that could actually relate the level of interest rates to the rate of inflation to the level of the economy, central banks are forced to basically operate by the seat of their pants, and just kind of like do it meeting to meeting. So I guess my question is, have you guys thought of what would be the right decision rule to use in this context? Do you keep on raising interest rates until inflation goes down? Do you keep on raising them until inflation expectations for the future go down? So how should central banks actually operate in this environment? And similarly, once we get to that stage, which we're not there yet, what decision rule should be used, to when central banks seek to start lowering rates again? And let me just add one last thought that I'll ask you to respond to, which is, even if the relationship between the rate of activity and the inflation rate is loose, or the Phillips curve is flat, is there some expectational benefit, basically to central banks acting hawkish and declaring that they're going to get inflation down no matter what? Does that go anywhere beyond just financial market participants and actually impact real life wage and price decisions?
Well, those are very pertinent questions. First of all, is there any particular rule or rule of thumb? Unfortunately not. And clearly this is a difficult predicament that central banks are finding themselves in. And first of all, transitions are not that common. And we are actually seeing the risk of a transition. And by risk, I mean inflation becoming permanently or for a very long time entrenched at a high level after an extraordinarily long period of price stability. So clearly these are difficulties. And it's precisely when you would like to use the models that the models really fail you. I say precisely use the models because in the previous regime, you didn't really need a model to forecast inflation. Roughly speaking, it was staying within a particular range, as I was saying. And when people say, well, what's the best forecast of inflation? Let's use a constant. And that sort of volatility aside, that's probably the best way that we can, that's the best guess that we have. So I'm afraid that there is no simple rule. And I'm afraid that you will have just to use your judgment as much as you can. But not presume that you can really set what they say or decide what the terminal rate is going to be. I would particularly look at, well, first of all, in terms of inflation, what's happening to inflation, there is no substitute by seeing ultimately what's happening to wage price decisions, which does mean that unfortunately, by the time you are there and you see them, it may be a little bit too late if you allow them to become these pressures to become entrenched. On the real economy side, leaving aside, of course, those economies that have been really battered by very, very high energy prices and the like, I would focus more on the financial aspects and see, in particular, I think what's happening to cash flows in households and corporates. I think that from the kind of work that we have been doing, the interaction between cash flows and, in particular, property prices, not so much equity prices, but property prices, is a particularly good way of thinking about where the economy is going.
Thank you. I would love to hear how our other panelists might think about that question. But first, we need to hear what Desmond has to say about the global economy and in particular the threat from China.
Thank you very much, Steve. I'm wanting to talk about China and the emerging markets, where I think there's a perfect storm. But I'd like to pick up on a point that Claudio made, and I think that is critical, is that what the central banks have done is they've created themselves not only an inflation problem, but they've created for themselves an asset price and a credit market bubble, which makes it very difficult for them to deal with the inflation problem without unsettling financial markets. And I think that this is all the more pertinent today, when it's not just an issue that we've seen a 20% decline in stock prices or a 15% decline in bond prices or collapse of the cryptocurrency markets. We're seeing cracks already in the financial system. We're seeing Evergrande, 20 Chinese property companies defaulting on their debts. We're seeing the whole debacle in England with the pension system that took strange positions in derivative markets that they had to be bailed out by the Bank of England. Italian bond spreads are widening. We're seeing emerging markets defaulting. So what I'm saying is that the financial system got used to zero interest rates. Now you're moving at the most rapid rate, things are going to break. And if you keep raising at these kind of rates, you're inviting stuff to break in the financial market. And I don't know that you can get that in a model. But I think that what one also has to do is look at what's going on in the international sphere. And I thought I would just focus a bit on China and the emerging markets, not least because they're rather important. So if you look at this chart, it's telling you, it's a little bit dated, but it's telling you that the Chinese economy is something like 16% of the global economy. So what happens in China really does have a bearing on the rest of the world. If you look at the emerging markets, you throw them in, you're at 40, 50% of the global economy. So you're talking about a big part of the global economy. What you're also talking about, when you look at the emerging markets, is there's a huge amount of debt that these markets have issued, which they can service at a zero interest rate when the world economy is doing too well, when the dollar's not too strong, but it becomes a different story, when you begin moving in a different phase. And that can come back to bite you in the financial system, in the United States. And I agree very much with the point that while the banks might be okay, the non-bank financial institutions aren't in good shape. So you could very well get a long-term capital management type of problem on a big scale, and I think that the central banks need to be mindful of that. Now, when you look at China, what is of concern is that China looks like it's got a perfect economic storm, that whatever can go wrong looks like it is going wrong in China. Immediately what we've got the zero tolerance policy, the zero COVID policy that's shutting down places. So we're seeing a big deceleration in Chinese growth. I'm more concerned about the other factors that are weighing down on the Chinese economy, not least that it's got a major property and housing market bubble, that once again works well in a global economy that's doing okay, but it doesn't do too well when things slow down. And then you've got the fact that President Xi is at war with the technology companies, that they look like they're reversing a lot of the reforms of Deng Xiaoping that set the country on a good path. You've got the United States now looking like it's declaring economic war on China, shutting down chip exports, and then China's got a demographic problem. So I just want to focus a little bit on the housing and the debt problem. This chart just indicates the kind of debt explosion that you've had in China, that they've now got debt levels that are similar to advanced countries. And if you look at this chart, which compares, the red line is the Chinese increase in credit to its non-financial sector between 2010 and now. You see that this is very much sharper than what we got in the run-up to the United States housing market bubble, or that's the blue line, or the green line is the Japanese lost decade, the run-up in the credit there. So the fact that you've had this kind of credit run-up, you now got to expect, I'm not suggesting that you're going to get a crash like you got in the United States, but you're certainly going to get China moving to a very much lower growth. Just for this reason alone, you should expect a very much lower Chinese growth going forward. Other indications of the housing problem, that the property sector in China is so much more important than in developed countries. You're seeing close to 30% of the economy. That's a problem, how you're going to rebalance it. And now what we're seeing clearly that you've gone into the bust phase of the cycle, that house prices, this chart is indicating house prices are falling the past year, consistently. So the whole Ponzi scheme looks like it's coming to an end. These are other indications of housing, just plummeting. So China also, which importantly, and this has got a bearing on inflation going forward, has a major demographic problem, that we're now getting the working age population declining. That makes it difficult for them to deal with the housing situation, but it also means that there's less labor supply, from China, that's been such a big force bringing inflation down. Growth, of course, is coming down way below what it was in the earlier part of the 2010s. It's now growing something like 3%. Looks like they're really going to be growing at a very slow rate for a long time. So where does it bring us on inflation? It looks like, to me, it looks like the Chinese question, it's got a mixed impact on inflation. From the short run, I can see that China puts less pressure on commodity prices. It's the largest consumer of international commodities, less pressure on global aggregate demand. It can also cause financial problems, defaulting as they are on their debt. But from a longer run point of view, so those short run effects I could see reducing inflation, but from a longer point of view, if we get supply chain problems, that's going to be problematic. We're just seeing it now with Apple and their plants being closed down. That's not too good. But more importantly, just from a deglobalization point of view, China was the way that prices were kept in check for a long period of time. We're going to be losing that. Briefly, just a word on the emerging markets. They're too in already a very poor shape, largely because they've got huge amount of debt. You see that in this chart. And now they're being subject to a whole variety of shocks, the increase in food prices from Russia, many of them having to import energy. That is not too good. And then it's not helping. This is a chart just showing the global food prices that they're having to deal with. But it's not helping as well that the Fed tightens policy what we get is capital being repatriated to the United States, and you're also getting a very strong dollar. So I think that that is something that central banks really have to take into account. My view of the world is that they're not paying sufficient attention to the financial market aspect of their tightening. That is going to lead to trouble. That's why I'm in the camp of that we're going to have a very hard landing, and inflation is going to be the least of our problems later next year. And the second thing is that I don't think that central banks are paying enough attention to the fact that we've looked like we've got a synchronized global slowing, and in China and in the emerging markets, it looks particularly pronounced. So I'll leave it there.
Thank you for that, Desmond. And maybe if you can stop sharing your screen.
There we go.
So we can see you better. Anyway, thank you for that, and congratulations on that soccer ball representation of the global economy, which was very nice.
It's just before the World Cup.
There you go. Exactly. So, so the question is the global economy being kicked around by the Fed, or are other aspects of it putting a lot of pressure on emerging markets? So the question I had for you really is, let's say that some of your direst risks come to fruition. Financial crisis, economic crisis in China, perhaps leading in a knock-on way to financial crises in other parts of emerging markets. How do you think the Fed should respond to that? Should it hold off on further tightening, even if it has not met its inflation goals? Or does it need to stay the course and get inflation down in the States, because that's what is needed for global economic stability?
No, we're going to be back to a kind of situation that we were in 2008, when things broke. The Fed really had to go for ultra unorthodox easing, or, during the crisis that we had with COVID, the same kind of thing, the same sort of thing here. If you get financial markets seizing up, if you get credit crunches, you get real distress, the Fed is going to have to change course, very quickly, and that is of concern. That is something that we should be thinking about, at least in my view, we should be thinking about right now. How do we get out of these cycles where we have these booms, we have the asset prices increasing, and then we have the bust, and then the Fed comes in again, and we repeat the exercise. We've been through a few of these. That it's kind of raises a question of what's the appropriate mix between fiscal and monetary policy. But just in terms of your first question, it's not simply the Fed is tightening. It's that the European Central Bank is doing the same, and that what we're not giving sufficient attention to, in my view, is that we're just looking at the interest rate increases. We're not looking at the fact that what the Fed is doing is it's reducing the size of its balance sheet now by $95 billion a month. So we've gone from a situation in 2021 where the Fed was pumping in $120 billion of liquidity a month. Now they're taking out $95 billion. So it doesn't really surprise me that you're seeing strains in the credit markets. And I would believe that if they continue down this path, 75 basis points every meeting, they're really just bringing forward the day in which the whole thing's going to unravel.
Thank you. Okay, so we've now come to the point in our webinar where we can have a little bit more open discussion. At this point, many of our audience may have gotten off because they're calling their broker and selling everything, heading for the hills. But there may be some that are left, perhaps optimists. And so I'd like to, so for starters, I'd like to open the discussion to any of our panelists that would like to address other comments that other panelists have made, or perhaps in particular, to respond to the issue that Desmond's raised, which is if we do have some kind of financial crisis, what should central banks do? Should they desist on tightening, stay the course, or what? So would anybody like to offer anything?
Well, we did have an episode.
Yes.
Where there was dramatic changes in long-term interest rates. And that did threatened financial stability. And there was emergency intervention by the Bank of England to provide a backstop in a targeted way to a specific set of instruments that were particular exposed to the sector at hand, the pension funds. But I think that rather than that being viewed as a continuation of sort of previous, 2008 kind of experiences, I think that what was done this time, there was the obvious above the transom intervention, providing a backstop, but there was also quite a bit of learning about exposures and a lot of discussion with the exposed parties. And in that sense, there was a lot of information flow. And I think that that's an important ingredient in the successful termination of that program on the time frame that it was originally designed to be terminated. And it was really, there was an awful lot of discussion and between the various parties involved. And I think that put us in a different position than perhaps other episodes where there was emergency intervention and perhaps more broadly. So I think in our case, the targeted intervention and a lot of the discussion that it was going to be terminated at a date certain was an important part of the exercise.
Catherine, are there any other lessons from that episode that you think other central banks can learn, both in terms of what might generate these breakages in the financial system, or how to identify them in advance, or how to address them?
Well, we already know that there are a number of other pension funds in other markets that, seeing the episode in the United Kingdom, decided to start those conversations earlier with the parties involved to evaluate stress tests and to evaluate exposures. So there was, there other, as I say, other regulators, as well as central banks, started to look under the hood a little bit more, and that's a good thing. We could be a good example that way. It's having one accident, you learn from it, and I think that's important. There's perhaps other ways in which of different kinds of stress testing, just different ways of looking at stress testing. And of course, Claudio and the BIS has been at the forefront of trying to get the kind of information that is necessary in order to understand the linkages between the non-bank financial institutions and how they are networked. And there's more work to be done there. There will always be more work to be done. But the BIS really has been at the forefront of trying to expose some of these linkages and the magnitude of them, so as to provide some daylight.
Would any of our other?
I mean,
Yeah.
one issue we haven't really talked about is fiscal policy.
Oh,
And
go for it.
fiscal policy everywhere is moving in the opposite direction of monetary policy. For some of it, there's some justification. The intense temporary pain in Europe associated with energy prices does call for some temporary relief. But all of this fiscal policy comes at the expense of higher interest rates. Higher interest rates bring with them more financial stability risk. And so I think we have the inverse of the only game in town monetary policy phenomenon we had coming out of the financial crisis. Back then, we had to do lots of QE with attendant financial risks as fiscal was absent. Now we have to do lots of interest rate increases because fiscal policy is absent. So I think that's the other lesson one can take from the UK experience. I think broadly, though, I found it comforting. The Bank of England, didn't necessarily anticipate this happening, but could act very, very quickly when it did. A lot of these problems are related to the speed at which things move rather than the level. And so you can just slow them down. And I don't think monetary policy should prophylactically avoid raising rates because it's afraid of uncovering some problem it didn't know about. I think if it uncovers the problem, it should try to deal with it, ideally without changing the stance of macro monetary policy. But if it needs to, that option is always available.
That actually addressed the point I was thinking, which is, so it sounds like we hold out hope that if there is a financial breakage as a result of rising rates and inflation rates, that it can be addressed through very targeted instruments without having to reverse the general thrust of tightening policy toward containing inflation.
Yeah, the best is targeted instruments. The second best is if you have to switch over to buying assets instead of selling assets for a little bit. If you have to slow the rate increases, you should try to avoid that. The worst thing, though, is to preemptively not raise rates because you're afraid of some shadow around a corner when macroeconomically it's still needed. I think you really need to do what you need to do for inflation and for your mandate.
Desmond had a question.
Yeah,
or a point.
I'm not quite so sanguine. When you've got debt that is so much higher than it was at the 2008 peak, we're something like 50% of GDP higher than we were before. And we know that a huge amount of that debt has been completely misallocated, that we've had borrowers who are uncreditworthy getting big loans at low interest rates. You're going to get a lot of incidents like the pension fund. You can anticipate that. That happens every time you raise these cycles. This is the whole story, I thought, with Hyman Minsky. But if I could just ask quite a different question, just on the mortgage situation, I just wonder why Jason isn't more concerned about a real crash in the housing market, that if you just do the simple math, if interest rates in mortgages go up from 3% to 7.3% in the space of something like 6 months, what it means is that the average householder, if they could afford a mortgage of $400,000 at the beginning of the year, they can now only afford a mortgage of $300,000. How are we not going to get a crash in the housing market?
I mean, we're to some degree getting one. The reduction in residential investment was larger in Q3 than any time since the financial crisis. That followed a large reduction in Q2. And everything indicates we're going to continue to see that. To some, I think it's a shame that much of monetary policy works through this one channel. That's why I think the strong dollar is welcome, because it helps broaden out the way in which monetary policy is affecting the economy. That's why I wish we had more fiscal policy in the mix. But yeah, no, we're going to see a decent, I think there's more room for house prices to go down and a lot more room for residential construction to go down. And that's, I think, part of the plan.
Howdy.
Yeah. actually, one should unpack. There are many aspects here. Let me just mention a couple. First of all, just focusing on market functioning and market disruptions per se. As I mentioned, the non-bank financial intermediation sector has grown tremendously since the GFC. Now, part of that was intended because it was the result of improving the state of banks and making them more stronger capitalized and so on. So there was quite a bit of regulatory arbitrage towards a sector that tended to be less leveraged. At the same time, what we are seeing, including in the case of the UK pension funds, there is quite a lot of hidden leverage out there, and quite a lot of liquidity mismatches out there, which are part and parcel of this market-based financial system in which collateral plays such a huge role. And we are really living in a collateralized or collateral-based financial market system, which is actually which is very liquidity hungry. And it's very easy to get these leverage liquidity spirals that we have seen in the past. Now,
Claudia, we're running out of time.
Okay. Well, let me just stop there and say that because central banks have so actively used balance sheet policy in order to carry out monetary policy, the stance of policy, they are indeed in a much harder position than in the past, because distinguishing this, I'm doing this for market functioning reasons, but I'm not really altering my stance. It's much less straightforward. It's much more difficult in the current environment than it was in the previous one.
Okay, I have a problem. We have 4 minutes left. And at the same time, I have a question from Ted Truman, who was my boss, was Catherine's boss. Maybe it was Jason's boss.
It was also my boss to some extent when I was working.
So I cannot ignore it. So I will ask you to use your basically 30 seconds apiece, maybe 40, to to give me a last message that includes some reference to how do you think this thing is going to play out beyond the 2 to 3 year horizon. So like beyond 2025. And we'll start in reverse order with Claudio, like a quick, and then, oh, excuse me, Desmond first, then Claudio, then Catherine, then Jason.
Yeah, I'm afraid I think that there's going to be a pretty hard landing. There's going to be a financial meltdown, and we're probably going to make the same mistake that we made before. We'll pump it up and we'll have yet another one of these cycles. But I'm just concerned that there's just so much more debt than there was before. And there's so much of this credit that's been misallocated that I don't see how we avoid a real hard landing. All
right, Ted, time to sell. Claudio.
Look, I'm not going to make forecasts, but it clearly, I mean, you got the big picture, which is basically we are facing unprecedented conditions. It is paramount for central banks to bring inflation down. And they are doing it in a context in which the financial side of the economy or the macro financial linkages in the global economy are going to play a key role. Fortunately, banks are in better shape, much better shape than they were during the GFC. But as we saw in the case of Archegos, if something goes bad in the non-bank financial intermediation sector, it doesn't necessarily stay in that sector.
All right, thank you. Catherine, you might want to unmute.
This environment where you have these cross-border linkages and they play a very important role, central banks are moving for their own reasons in the directions that they are. But nevertheless, the cross-border linkages, both finance and on the real side, I think it behooves all of us as central bankers to work closely, communicate closely with each other so that we have an eye on each other's back.
That's what the BIS is for. Jason, you get the last word.
3+ years, we're beyond whatever gyrations we're through now. How do we come out of it differently? I think there's a chance we come out of it at a higher inflation rate in a way that's good, maybe something more like 3% that would give us room. That might be a formal target, more likely something the central banks just tolerate for a while and everyone gets used to it. In terms of output, I think the level of output is lower as a result of this, both the people that left the labor force and potentially some productivity reductions, but there's no reason one should change one's forecast of the growth rate of output based on the experiences we've gone through.
Excellent. Thank you all very much for tuning in, using your valuable time to help educate our audience. And thank you to the audience for tuning in. It's been a great discussion. I have many other questions to ask, and I will try to ask them at a future point. Thanks to all of you.
Thank you.
Thank you.
I think we're